Well, as expected, South Africa's central bank kept its benchmark repo rate at 6.75% and the prime lending rate at 10.25%. We're going to get into a conversation about whether this was the right call, even though we have a rand that is looking really pretty at 12.19. But before we get into that conversation, let's actually hear what Reserve Bank Governor Kganyago had to say.
While household consumption expenditure is expected to be supported by positive wage growth, it remains constrained. The economic growth outlook is also more positive, but fragile. At this stage, the MPC assesses the risks to the growth forecast to be more or less balanced. The endogenous interest rate path generated by the quarterly projection model has changed slightly since the previous meeting. Whereas previously, 3 increases of 25 basis points by the end of 2019 were indicated, the third increase is now a marginal call. Furthermore, the timing of the first increase has been pushed out later in the period. The implied path remains a broad policy guide and could change in either direction by the next meeting in response to new developments and changing risks. In light of recent developments and the balance of risks, the MPC has decided that it would be appropriate to maintain the current monetary policy stance at this stage.
And that is the moment where all our hearts sunk, because we realized that we weren't getting any relief anytime soon. Joining us for an analysis of the MPC monetary policy decision is Jan Sluis-Cremer from Foreign Exchange and Money Market Sales at RMB, and Annabel Bishop, Chief Economist at Investec. I'd like to start off with the Economist, Annabel, if you'll allow me. You guys got it right. A few of you expected or said that the SARB should have cut rates. Did he make the right call?
Well, essentially when the Reserve Bank targets inflation, it looks out to future inflation. It doesn't target at what's happening at the moment, because it really can't affect it when it changes interest rates. So essentially they do look at 6 to 24 months out, but actually they really focus on the 12 to 18 month period out. For us, that's the second half of this year and obviously next year. And with the Reserve Bank's inflation forecast at about 5.5% for next year, and obviously around 5 for the second half of this year, he didn't have room to cut essentially. So
what happened to balancing inflation with weak growth?
So I think that's a very good point. And actually the GDP growth forecast the Reserve Bank have now picked up, and they've got them now at 1.4% for 2018. Previously they had 1.2%, and they've got them at 1.6% for 2019, and previously they had 1.5%. So you can see they're starting to lift up the GDP growth forecast. And of course, as you know, the potential growth rate at the Reserve Bank calculates with the South African economy is around 1%. So if these economic growth rates are above that, that actually signals some further inflationary pressure for next year.
He says that the rand is still susceptible to political outcome. I joked with Fifi earlier that we are over Zuma. They aren't any negative political outcome.
In fact, there's a
you
meeting
can't say that
today.
when the rand is at 12. Come on. Like, we're doing better than ever before. So I'll ask Fifi's earlier question. Why didn't he cut?
No, look, I mean, I kind of agree, and we were in the same camp that there's going to be no cut today. I think, you know, he's got his hands tied a little bit, and, you know, we can look at the macroeconomic front where, you know, it clearly says that, you know, you can't really have a cut, but we got some short-term, you know, things coming up in the next couple of weeks. So we got a budget in just over a month's time, and we got to find a lot of money to fund a lot of things, and nobody kind of quite knows just yet where that money's coming from. We got SOEs that are seemingly starting to now become under pressure. You're seeing it in the press every day and on the radio and television, where they're finding it difficult to fund themselves, which is a big concern. And then thirdly, and probably most importantly, is we still got rating agencies hovering around for post-budget to see what exactly happens. So you don't want to go into an environment cutting rates, and then in May, you've got to go and raise rates again.
but we've also got a household or a consumer that is under severe pressure, and we're seeing that in the retail numbers that have been coming out from our retailers. We've got no money to spend at these stores. If we had money to spend, you know, everybody would grow, investments would fall, investment would increase, the blah, blah, blah. And we've got a SARB that's saying that, okay, we might not hike interest rates in the coming year 3 times, but we still might hike twice. I mean, really? Twice? Is that the right thing to be doing right now against this backdrop of weak growth and a constrained consumer, i.e. myself?
You're talking to your book. Look, I think essentially, you know, they have obviously given us a bit of leeway. They've dropped this down from 3 to 2 hikes. You said maybe one way to understand the Reserve Bank is they tend to actually react maybe at the next meeting more to what's happening at the moment now. You know, so things have improved a lot. And what I'm really saying is they don't know if this rand improvement is sustained. They don't want to come to the March meeting and find that actually we had a credit rating downgrade and the rand suddenly turned around and blew up. You know, then what would have been the point of an interest rate cut now? So maybe that's one way to look at it. But certainly looking out, you know, we are looking at economic growth of around about 1.6%. It's markedly up on a couple of years ago when we had 0.3%. So from that perspective, they see there's a significant improvement. But the bottom line for them is they believe that cutting interest rates are not going to spark economic growth. We actually need fundamental changes in South Africa. We need reforms. And we really need economic policy certainty. And I think, you know, Cyril Ramaphosa spoke recently about, he said, yes, the political uncertainty is reduced, but the policy uncertainty hasn't. You know, we still are at risk of credit rating downgrades. There's still concerns coming through from a number of other areas like the state-owned entities. So I think the Reserve Bank's being cautious. They don't want to put forward an interest rate cut now, but they'd actually have to reverse quite soon down the line, should perhaps we do get a downgrade from Moody's as early as February.
And how worried are you about, I mean, we've already articulated the worry with regards to Moody's and them possibly downgrading us come February, but are you worried about the upward trajectory of the oil price?
Yeah, look, I mean, that is going to have some negative impact on inflation at the long end because, you know, if oil price continues going up, you know, you're going to see a higher petrol price and it eventually filters through into our economy, and all of us get affected every time we go to the supermarket to go and buy our daily meal. But I do kind of think, you know, oil has come a long way over the last year and a half. You know, if we think this time 2 years ago, we were down at the $25 a barrel, and everybody was calling doom and gloom and we were going a lot lower. So it's kind of sustained those levels, and we've gradually ticked up over the last 2 years. I do think it's probably oil in the short to medium term is probably looking a little bit toppish. You know, once the US and stuff start getting reserves back up again, you know, you could possibly see this oil price coming a little, you know, a little stronger from current levels, around about the $70 a barrel.
And talking about those US reserves, I mean, it could be really soon that they start doing that because we've got companies, US companies that are taking advantage of that favorable tax arrangement announced by Donald Trump. We've got Apple bringing in its monies. It's probably one of many to come. So you've got a whole lot of money that's coming into the US economy. We've got a market that's already priced in the fact that US interest rates are going to increase this year. So I take it no action expected on that front. So you've likely got a dollar that's expected to continue on this weak trajectory and likely be supportive of the rand. Therefore, you know, inflation possibly not being such a big deal for South Africa.
No, I mean, in the short term, and if you're just looking at the dollar and at the current oil price, then no, it shouldn't have a long-term effect on inflation. You know, I think what you've got to be wary of is that something goes wrong in the next 4 to 6 weeks in terms of budgets, how we're going to fund ourselves, downgrades, and suddenly we see the rand from 12 Rand 20 where we currently are back to where we were pre-ANC elective conference. And I think that's got to be the biggest concern. And the governor made mention of, you know, volatility today in his speech, and we can't, you know, be seen to, you know, well, the rand's now 12.20, we're here to stay.
12.19. Gets better and better.
1 cent means so much.
There's no cut. It's so painful.
But also, as Garabo mentioned, I mean, we've got meetings currently happening in the ANC headquarters regarding a possible exit package for, you know, the state's #1 right now. I read your morning note this morning. It said that should that happen, we could possibly see the rand go to 11.25. Is it 11.75? So?
Yeah, look, I mean, I think you know, we've been led to believe over the last couple of weeks now that, you know, the president's exit is imminent. I actually think the longer he stays there, it's going to be, you know, there are a multitude of facts that are keeping him in place. Cyril Ramaphosa currently doesn't have the support or the strength within his own party. So if you get rid of him today or tomorrow at the NEC or over the weekend at the Lekgotla, you're going to create big divisions within the ANC, and they're trying very hard not to do that. But I certainly think end of first quarter, second quarter, there's a chance, you know, that he does go. You've got to remember that it took Jacob Zuma over a year, nearly 2 years, to get rid of President Mbeki. So, you know, I don't think we can expect everything to just happen overnight. As much as we're wanting to see, you know, we go to bed tonight and we on plan A and we wake up tomorrow morning and we've moved along and, you know, the president's gone and growth is at 3% and the rand's at 11 Rand 50 and all those type of wonderful things. It unfortunately doesn't work that way. But I just kind of think if we do continue on the trajectory we're going, there's no reason for the rand not to go down to 11.75 and even lower. I mean, we can sit here and we can look at longer end targets. I mean,
well, the purchasing power parity is at 10.50 at the moment, 10 to 10 Rand 50, and you know we actually see it going back to purchasing power parity in a couple of years. By then it'll probably be closer to about 11, you know, 20, 11.50. But certainly there's that possibility if we do see Cyril Ramaphosa come in, if we do see a huge lift in business confidence that feeds through into economic growth and fixed investment.
So what you guys are saying is that we've been doing things okay, I guess, over the last couple of weeks since, you know, the ANC got its new president, and that we need to keep doing them. Now, if we're on a knife edge now, what kind of things do we need to do leading up to getting us a favorable outlook from Moody's come budget day?
Well, certainly we need to have a very strong focus on fiscal consolidation. You know, the rating agencies only look at one thing, and that's your ability to repay your debt. So they're essentially going to be assessing us for our credit worthiness. And if we continue to show this upward trajectory, which we are seeing in government borrowing, you know, debt as a percentage of GDP, that's very bad for our credit ratings down the line. The same goes for the management of the state-owned entities. You know, we need to pull that back in quite sharply as well in terms of the amount that they want guaranteed, in terms of the exposure that we've got to that as a country. Because, you know, if Eskom defaults, for example, South Africa is liable. We are liable for to repay the debt.
Default on one.
And but it gets worse because then our government would then have to issue more debt essentially, or even default itself, because it, you know, in order to make that payment, it doesn't have spare cash lying around in huge amounts to make good on Eskom's debt.
Does it sound like Steinhoff a little bit?
There's hope. That hope comes next week. Deputy President Cyril Ramaphosa very hopeful of selling South Africa there to the investment community. We need investments. Investments could be something that could possibly get growth going again. How confident are you that the foreign world will say, all right, South Africa, okay, we're ready to do business with you. You look like you've got your house in order.
I think there's going to be a bit of a sea change from Davos last time round. You know, I think people are going to be a little bit more optimistic to South Africa. Also at the IMF meetings we had last year as well. But I think certainly they're going to say, well, look, it looks like you're now starting to go in the right direction, but are you actually going to make the changes? And of course, the thing to remember is that the business community is very hasty. You know, they want it all now. They don't want to wait for this process, as we were explaining just now, that you need to go through several stages, you need to garner the support. You know, Cyril Ramaphosa's actually done amazingly well. You know, given that there was very strong factions, you know, looking for a different outcome to this ANC electoral conference. And now he needs to create unity, he needs to draw everyone in. And it's probably better to solidify that than to be too hasty and move forward too quickly. But the business community, of course, wants it all now. They want rapid change and not just business. And of course, you know, the same for the rating agencies as well.
And same for the consumers. We want rapid cuts in interest
change.
He doesn't have to get fired. He can also tender a resignation. Go.
Jay, guys, thank you so much for your time. That, of course, was Jan Sluis-Cremer, who's a foreign exchange and money market sales at RMB, and Annabel Bishop, a chief economist at Investec.